Welcome back to The Sweet Life. We have a very urgent update because stocks are ready to fall some more. I'm going to give you exactly why that is. Let's hop over to the screen first, and then we're going to dive into 8 different type of models that are showing us a potential for more pullback on the stock market and what you can do as a smart investor. So right here we have the S&P 500 at 4108. Now if I zoom out, and I'm going to zoom out 1 year, and that really kind of shows us that we've been in this bear pattern since 2022. I mean, 2022 has been an absolute ruckus ever since we began. I mean, look at this, just a downward trend. Sure, we had a little bit of an upswing back in the late March period, but we're still going back down. But there are 8 valuation models that are pointing to the fact that this is only just the beginning. In fact, the stock market could still be overvalued. Some of your favorite stocks could still be overvalued. And as a result, especially with the Fed increasing interest rates, that's going to put additional pressure on a potential recession, but more importantly, making those overvalued stocks continue to recede back. So what do we do as smart investors? Now, first we got to start right here on this article, Valuations at Stock Market's Mid-May Low. Now, I know that's a little bit of time ago, but this is really important. If we look at the past 50 years, look at what this chart is telling us. These are the 8 valuation models that we need to zoom in on so we can understand what our next steps are going to be as investors. Now, look at this. The most undervalued reading of the past 50 years. Now, if you're new here, undervalued means that there's not a lot of people valuing what that stock or that ETF really could bring. That basically means this could be an opportunity to consider buying if you do your fundamental research, because there's not a lot of attention on it. When it gets into overvalued territory, that means people are dumping all their money in, they're very bullish on it, and the problem sometimes with that is that it's due for a pullback. And that's the problem I see a lot with stocks, and not only stocks but also cryptocurrency, is that we hear about these things on the high. Everybody wants to talk about it when it's exciting, and then the new investors say, oh my gosh, this is exciting, I need to jump in. But the problem is they're jumping in at the high when typically these things are overvalued. Guess what that means? You're enjoying the roller coaster ride all the way down for whatever pullback that is. Now, stack on top of the pullback a recession potential with the Fed increasing its interest rates and much, much more. This is an interesting piece. Now, if you look at mid-May, right here in the center of the chart, you can see that it's right in the middle of the PE ratio. Do you see that? That's a big deal, and that's something that we need to keep our eye on. If you look at the Q ratio, the Buffett ratio, the dividend yield, price to sales ratio, and price to book ratio, everything in May, in this past month that we just got out of, is all the way up here. If you look at the most undervalued reading, and that would be the past 50 years, think about we had the Black Monday of 1987, we had the 2009 crisis, we have a lot of things going on where that would be all the way at the left-hand side. But no, we're still way up here, which means there's a potential this could go down even further, and very soon I'm going to share exactly where I think this could go and how to take advantage of this. The big thing that we need to focus on is the last one, the CAPE ratio. Let's hop over here and talk about why that CAPE ratio is so high and what that might mean for the future. The CAPE ratio, otherwise known as the Shiller ratio, is an acronym for the cyclically adjusted price to earnings ratio. This ratio is calculated by dividing a company's stock price by the average of the company's earnings for the last 10 years, adjusted for inflation. That's a very big piece, is adjusted for inflation, because all of these things over the last 10 years give us a better understanding of a long-term trajectory so we can see, are we highly overvalued, are we undervalued, potentially an opportunity to buy. Now, take a look at this incredible chart and look at the date. It goes all the way back to 1880. What a phenomenal piece of data. And this is where I am a little bit worried. Now, even though we want things to continue to go on an upward trend in life in general, we got to be serious, take a step back, and think about this from the overall standpoint of 32.13. If the Shiller, otherwise known as the CAPE ratio, is at a 32.13 right now, look at the opportunity it has to potentially come back down. Now, I'm not saying that I'm predicting that we're going to have the 2009 crisis happen again. I'm not even predicting to have any type of issue like Black Tuesday or Black Monday or anything that happened way back in the old days. But one thing that we could see is that as the Fed continues to increase the interest rates, we're going to see a pullback. And if we're saying it's at 32, which is considered overvalued, when the mean and the median is at 16 and 15 respectively, right down there it is. That's kind of where I want to say, okay, if we're right in that territory, that's what I'm looking for. So here's what I'm personally doing. Right now, I'm looking at 2 different things. I am looking right now into ETFs. Of course, I got my crypto holdings, my dividend earnings, and my individual fund stock picks. But the beauty of things like a VTI or a VOO, track more than just one particular stock. You can buy a share of VOO, Vanguard's S&P 500 fund. The beautiful thing about that is it tracks all 500 funds in the S&P 500. If a company fails in that particular holding, it doesn't matter because guess what? There's 499 other companies that make up a VOO. So picture this. You buy a company called ABC Company. That company crashes. They announce bankruptcy. You invested $1,000 or $10,000 or even more, and now all your money is going down, down, down like the Terra Luna crash in cryptocurrency. It's not good. It loses a lot of money. It's a little bit scary. But if that same company was inside a VOO, what it would do, of course it would bring down VOO a little bit, but because it would fall off the S&P 500, VOO would knock it off its list and invest in a different company that then stood up to the S&P 500. Call it self-cleansing, and I think that's a phenomenal word for these type of funds. They're always cleansing themselves, giving you an opportunity to ride the waves of the stock market. And that's where this and these 8 valuation methods are very, very crucial. Not a lot of people, I don't think, are going to watch this video because a lot of people are going to be worried about what the next big thing that's going to the moon is. But some of the smartest and richest investors, the wealthiest investors, in fact, buy when things are looking kind of nasty. Right now, yes, things are down, but there could be an opportunity for this to keep coming down as the Fed continues the interest rates, as I've said a million times. But that is a key point that you really should be writing down. So here are the things I'm looking for. Number one, if this goes to the 20s or even lower, that's an opportunity to get a little bit more aggressive with my investing. Number two, I'm going to be looking at the interest rates. Not to beat the dead horse 5 more times, but with the Fed increasing those interest rates, you want to keep your eye on the news. If they continue to come out saying, hey, inflation's too high, we need to continue to increase this interest rate, that's going to continue to pull down the market because that is what has happened over the last 10, 20, 30, 40 years. So that's an opportunity to also consider buying on the fear. And then number 3, I'm going to still invest on a consistent basis. Even though I'm going to set some money aside for when this really pulls back, I want to continue to invest because not investing at all, your money kind of erodes because of inflation. So I continually buy into VTI, which is not financial advice to you. Do your own research. This is the ETF that tracks all 3,000 plus funds in the overall stock market. And that's why I want to continue to buy into a fund that tracks everything. I want all the winners, I want all the losers in one single fund. I'm also going to continue to dabble a little bit in my fund stock picks, and I'll tell you, on my stash account, which is when I was really buying a lot of the funds back in 2020 when we were on the crash, I was going crazy on those particular funds. Delta Airlines, Apple, even Royal Caribbean, Carnival Cruise Lines, things like that. Even with the dip today, my overall holdings within stash is still up 17.23%. If you're looking at your portfolio and you see it in the red, think about it from the standpoint of when people are fearful, that's when you need to get excited. I'm always finding ways to make new money so I can push it into the stock market when things aren't looking good. Is it scary to do that? Absolutely. Will the market keep going down? Potentially. But I'm going to keep doing that until eventually it feels better. And then when it feels better, you ride the wave all the way to the top. And then when the next correction comes, you're still up 17.23%. And that's why I think it's so important to stay consistent with your overall portfolio. And if you want to see more videos like this, make sure you subscribe. Check out this video next. We'll see you on the next video.